bonds are common types of fixed income products. They're known as what's called defensive asset classes. And bonds are a really common way for companies and governments to fund new projects or ongoing expenses. And unlike shares, which are performance based, bonds have fixed returns. So through bonds, investors are paid these fixed returns until their date of maturity. And that just means until the investment period is over. So, for example, let's say I'm the Australian government and I want to build a new stadium for an upcoming event. It could be the World Cup or the Olympics, whatever we'd need another stadium for. And I decide to issue bonds to raise money to build my stadium. So I issue a bond to investors for $1,000, which I promise to pay back in full after 5 years. And to make the bond more attractive, I will also pay an interest rate of 5% every year, which is $50. So once the bond reaches maturity 5 years later, investors receive their full $1,000, plus they get to keep all the interest from the 5 years too. So at the end of the day, everyone's happy because I got the money I needed to build my stadium, and investors received regular interest payments, plus they got their full initial investment back. And this is why bonds, they're often viewed as a more predictable or stable investment. And they're also a great tool to help governments and companies fund all sorts of projects and ongoing activities.